On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and joining me today is Bob Dole. He is the president, CEO, and CIO of Crossmark Global Investments, located in Houston, Texas. Bob, I get a lot of experts coming on the show with me, and they tell me that things are great in the stock market. It just continues to persevere despite the headwinds that might be coming out of Washington, geopolitical issues, etc. Yet you put out a note recently talking about that we're in a high-risk bull market. These analysts are telling me stocks are going to continue to rise, but what do you think is going to happen?
Yeah, so the bull market part of that carefully chosen phrase, Todd, is the path of least resistance is higher. You've got to be involved. The high risk part says, but valuations are very high, speculation is creeping in. So don't go too far from your portfolio. I don't advise going on a 90-day climb in some mountain somewhere where you can't be in touch. So be involved, just be very careful what you own and watch this speculation.
So you mentioned high valuations, though, and let's expand on that a little bit because right now it seems that historically speaking, stocks are actually likely placed where they should be. I mean, do you believe it's just because we've had a bull rally for so long, the third quarter was so great that now is a time that it's just going to pull back, or is there a real justification for it?
So the high valuation comes from price to earnings, price to book, price to sales, EBITDA, EV to EBITDA, 6 different measures that are all relative to history in the top decile of historical
Okay.
valuations. Now, you and I both know valuation is not a timing tool. All valuation gives you a sense of is your risk reward. Now, long term, we know when valuations in the past have been at these levels, subsequent 3, 5, and 10-year returns are pretty puny. Doesn't mean stocks are going down tomorrow morning. It just means there's higher risk out there. Look, have new things entered the picture around trade and China problems? Yeah, and that's created a little more turmoil over the last week, if I can be short term about it. But we still think the path of least resistance to follow through is to the upside. You've got to be invested.
Well, you are referencing what happened on Friday when the president came out and talked about, quote, massive tariffs on Chinese imports and sent stocks reeling. We were down 2.7% in the S&P, and that volatility is actually carried over into this week. But with that, though, I mean, the tariff argument was always that we were going to have very high inflation. It was going to really impact consumers and therefore earnings. I know it's early in the earnings season. We just saw the bulge bracket banks report over the last 48 hours, but so far things are looking pretty good. I mean, what's your outlook for the earnings season?
Yeah, there's no question that earnings so far, it's early, as you point out, have been quite good. The banks have given us unbelievable earnings.
Yes.
The question is that all sustainable? Now, uncharacteristically, analysts during the quarter, the third quarter that is, move their estimates up. Usually during quarters, estimates move down. That they've moved up and the market's moved up just means their hurdle rate's a little higher. So our view is earnings are going to be good this quarter, but I might say it this way. For the market to trade at these kind of multiples, earnings better be good. There's not room for disappointment.
So let's flip the page here. So in your commentary with Crossmark Global, you had mentioned about the weakening labor market. You have you're putting out metrics that really are quite concerning right now. What is your outlook though? Because now with the immigration policy out of the White House, it does give the impression that we don't need a 6-digit gain in jobs each month. But what's your opinion right now as we move forward into the fourth quarter?
I think you nailed it. Normally, we think of you need like 100,000 jobs a month to sustain the unemployment rate at wherever it is a point in time. I saw one report recently that said you only need 30,000 new jobs. And the main reason is just what you said. Nobody's coming to our country.
Wow.
We've closed the borders. I'm exaggerating, but you get the point. So I think the labor supply and the labor demand have basically flattened out. In other words, you can see stats that show companies are not hiring, but they're not firing either. They're kind of twiddling their thumbs trying to figure out what's the world looking like? What's it gonna look like?
Right, right. So with the markets, as we go into further into the fourth quarter here, you have this is a peak time for shoppers. The American consumer continues to spend regardless of the labor picture, regardless of what's happening anywhere else in the world. What's the outlook like in Houston? Are you getting the feeling that this is going to be a robust shopping season, that Q4 is going to be great, and therefore we're going into 26 on a high note? Or do you think there is that still that high risk, like you mentioned, cautionary tale for consumers?
So again, I'll use the same argument with valuation levels where they are. Shopping season better be good. As we know, last season, a year ago, holiday season, spending was up nominal 9%. Estimates are that this shopping season they're going to be up 5%. So presumably retailers are planning for 5, and if they're 5, that's probably okay. But we can't afford to have them come in at 4.8 or 3.2
Hmm.
if in fact the expectations are high, which comes back to bull market, you better be there, but just be vigilant and careful that we meet those estimates.
Okay, okay. So now let's spin out of this to the Fed. Now you have a pivotal Fed meeting that's coming up. The feeling is that just like they gave us the indication in the last meeting that they will be cutting rates again. My question for you though, and you were an executive, you are an executive now, but you're at Merrill Lynch, Invesco, big firms. How can the Fed come out with a real decision when it meets if the government is still shut down and the metrics aren't coming in?
Yeah, great question. And I think, look, we could argue perhaps the Fed is too data dependent. Maybe they should look forward a little bit, not so much
Hmm.
in the rearview mirror. But look in the rearview mirror, it's a little cloudy because of the absence of the reports. Now, when it comes to labor, you undoubtedly know that the monthly employment report we don't get because they're closed. But there are a lot of private reports that come out that you can follow, and they're showing signs of job growth is good, but it's not as good as it was. So it's not great. Maybe I say it that way. So there is some slowdown. And the debate, of course, the bull says, don't worry about it. And the bear says, yeah, but if we've slowed down one point, we're going to slow down another point, et cetera, et cetera. As it
Yeah.
relates to the Fed and what they're going to do, Todd, our view had been coming into the fall, Labor Day, that they cut 2 times, likely September and December. I think the fact that the government's closed, the Fed might want to take out an insurance policy and say, we really don't know. So we're going to cut another 25 in October. So we may get 2 more this year, not out of the question. And that's certainly what the Fed fund futures curve is indicating, 2 more cuts.
You are right. The conventional wisdom would tell us that it would be okay for them to cut at the next meeting, despite not having the actual data being provided to them, only because on the surface, and you read the news stories coast to coast, it doesn't you don't need to be super smart to understand that the labor market is weakening and would probably a cut would be warranted. With that though, what are the clients across Mark? I mean, I'm sure your clients are calling you. They're probably ringing the phones off the hook, probably wondering, what do you do though? Because if the Fed does cut or doesn't cut or whatever, this government shutdown is continuing to move on. It will have an impact on GDP. So, what's the best theme for Crossmark investors these days?
Yeah, we're really focused on companies that have reasonably low price to free cash flow ratios, where the cash flow is accelerating, but at the same time have strong profitability measured at return on equity, ROE. So if you can find cheapness with above average profitability, we think that kind of environment or this kind of environment warrants having those kinds of stocks in the portfolio.
And,
Uh,
oh,
Go
go
ahead.
ahead.
I was gonna say, but coming back to your the last conversation we just had, inflation has to enter the question mark as well. And I think the Fed chair yesterday in his speech said It's getting tougher for us out there, didn't quite say it that way. We want to fight the potential for job weakness, i.e. lower rates, but inflation's not coming down. It's not 2% like we're targeting. It's 3 and a fraction and rising. So the Fed's job's getting harder and harder.
Bob, what's your opinion on that? Should the Fed just maybe backtrack off of the 2% and stop holding to it? I mean, where did they even come up with the 2%?
Yeah.
And
Well, I think they came up with it too because part of the last few years we had almost a decade where it was 2, but that's
okay.
not normal in the United States. I write a weekly investment commentary, and I think just about every other week I say the inflation rate is not going down to 2% absent a recession. It's stuck at 3, and we are a society that is 3, and we can live with 3. The problem is the stock market, I think, at these valuation levels is discounting 2% inflation. So if the stock market wakes up and says it's not 2, it's going to be 3, valuation levels probably come in. It's part of the high risk bull market comment we made earlier.
Okay. So, okay, let's talk about that a little bit though, on the inflation front, because all the talk was about these tariffs. Liberation Day, we saw, as you know, markets had crashed at that point, and then the fear was that we were going to have super high inflation only because of the tariffs. It hasn't happened yet. Or what's your analysis telling us? I mean, are we thinking that it's just delayed, that we are going to have higher inflation in 26, or do you think everything might be in check?
So we were among those who did not think we were getting a high inflation, but
Okay.
higher inflation, yes. And it's crept up. It got down into the low to mid 2s, and now it's over 3. So inflation's been creeping up. I don't think we're getting high inflation from the tariffs. I think we're going to get sticky inflation, meaning, you and I could talk 6 months from now, and it's probably be closer to 3 than it is 2, and that may bug the Fed.
Now, okay, and then we're talking about a whole new Fed chairman at that point, and
Yes.
a whole new makeup of the Fed. So who knows what's going to happen at that point? One final question. I want to go back to the part where the themes where you're talking about looking at cheaper valuations or opportunities that are there. The question I have is, are you able to find anything right now with valuations being at the levels that they are?
Yeah, the answer is yes, because we're always looking relative to benchmarks. So most of our products, our long only products, are fully invested. And therefore, we're looking for the best combination of price to free cash flow and return on equity. We're not pounding the table and say things are cheap, but here are cheaper names than other names that fit in the portfolio. And you can find them across lots of different sectors.
Okay, okay, very good. Yeah, did you
Which
want to?
I might add tend
Yes.
to speak to quality in the portfolio as well. And we all know in the last few months that's been the exact wrong place to be. The market's gone very speculative. The junkier the company, the higher the valuation. Stocks with no earnings have outperformed stocks with earnings here in the last a few couple of months, and we're not sure that's sustainable.
Okay, so this is my final question then. Would one of those sectors be real estate? Now that you have longer on rates on the longer end of the curve are actually dropping because of the Fed rate cut, do you think now would be one of those opportunities to get into really what has been just a crushing sector in the real estate market?
Yeah, we're not there yet. Looking at it for the very reasons you just suggested, but we haven't pulled the trigger. We still think that there are question marks about the earnings, and as you know, even since the Fed lowered rates, the longer term rates have been firm and a bit stubborn, which has not helped. It's not helped the mortgage market much either.
Okay. Yeah. I'd say you're right with that one. Well, Bob, this is great. I know the audience loves having you on. You always bring the best answers and the best quality. And I do welcome everyone in the audience to definitely go to the website at Crossmark and take a look at the commentary that Bob writes weekly. There's a lot of great stuff there. Bob, I got to have you back again on the Money Path. I
My
love having you on.
my privilege and pleasure. Pleasure. Thanks much.
Absolutely. So, on behalf of Bob Dole, I am Todd Schoenberger. Thank you once again for joining me on the Money Path. Coming up next is Sam Stovall from CFRA Research. We'll be talking more about the markets. So, thanks again. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.